Between October 2024 and January 2025, the Indian stock market experienced a dramatic fall. This decline wiped out nearly 1 trillion rupees from investors' portfolios. The benchmark indices, Nifty 50 and Sensex, witnessed their longest losing streak in over 2 decades. This period of uncertainty left many investors worried about their financial future. The market downturn was a result of a confluence of factors, both global and domestic. Understanding these factors is crucial for investors to make informed decisions. This period serves as a stark reminder that stock markets are inherently unpredictable. A major factor was the aggressive monetary policy adopted by the US Federal Reserve. To combat high inflation, the Fed continuously raised interest rates. This made the US Treasury bonds more attractive. As a result, foreign investors pulled out their money from emerging markets like India, impacting the Indian rupee and stock market. Adding to the woes, many Indian companies, especially in the IT and banking sectors, reported lower than expected earnings. This dented investor confidence, further driving down stock prices. The Indian rupee also weakened against the US dollar, hitting record lows. This made imports costlier, fueling inflation and impacting companies dependent on imported raw materials. Global geopolitical tensions further aggravated the situation. The ongoing trade war between the US and China created uncertainty in the global market, impacting India, which is integrated into the global economy. These factors collectively contributed to the significant downturn in the Indian stock market. It is important to distinguish between a market correction and a market crash. A market correction is a short-term decline of 10% or more in a stock market index. A crash, however, is a much sharper and steeper decline, typically exceeding 20% or more. While the Indian stock market witnessed a significant drop, it was categorized as a correction and not a crash. Corrections are a natural part of the economic cycle and are often followed by periods of recovery. They present opportunities for long-term investors to buy stocks at lower prices. Understanding the difference between a correction and a crash can help investors stay calm and make rational decisions during periods of market volatility. Section 4. Green shoots of recovery, reasons for optimism. Despite the initial shock, the Indian stock market showed early signs of recovery. By late March 2025, the Nifty had recovered all its losses, indicating renewed investor confidence. This rebound was fueled by several factors, including the return of foreign investors. Attractive valuations after the correction lured foreign investors back into the Indian market. Domestic institutional investors also played a key role by increasing their equity holdings. Analysts projected a strong recovery for the Indian stock market, with the Nifty expected to reach new highs by the end of 2025. Macroeconomic factors also supported this optimistic outlook. Decreasing inflation provided room for the Reserve Bank of India to consider rate cuts, potentially boosting economic growth. A strong monsoon season was predicted, which would be a boon for the agricultural sector and rural demand, further driving economic growth. Section 5. Every cloud has a silver lining, a long-term perspective. The 2024 to 2025 stock market correction, while unsettling, served as a valuable lesson for investors. It underscored the importance of diversification, disciplined investing, and a long-term perspective. Market downturns, while challenging, often present buying opportunities for investors with a long-term horizon. Instead of panicking, investors should view such events as opportunities to reassess their portfolios, revisit their investment strategies, and consider investing in fundamentally strong companies. Remember, the stock market is cyclical, and periods of decline are inevitably followed by periods of growth. Patience and a long-term perspective are key to navigating market volatility and building wealth over time.